In mutual fund, the risk and return, that is the performance of the schemes, are most sought after topic. Every investor will ask for that. Every distributor will like to know this. And also from examination point of view, understanding risk and return is very, very important. This is a very big subject. We'll cut it short to the extent only that it is useful to us from the examination point of view. Okay. Now, first of all, the first word, risk. Risk means what? Uncertainty. People say, or many people will say, risk is loss. No, risk only means uncertainty, not loss. No, we'll have a discussion on this in some other classes, why we say uncertainty and not loss. But right now, risk means uncertainty. And then you will find there are so many risks which is written over there. No, I will just speak it out and then I will explain them one by one to you. Systematic risk, liquidity risk, interest rate risk, reinvestment risk. Very, very important. These four risks are there. And thereafter, you have those risks which may not be so important to you, but then it is written in the book. Political risk, economic risk, foreign currency risk. Credit risk is very important one. Fine. Rating migration risk is also called downgrading or upgrading risk, reinvestment risk, and term structure of interest rate risk. So different types of risks are there written, and out of that, 4 5 are very, very important from examination point of view and also from understanding the schemes of mutual fund. Now, you can say that how we can calibrate, how we can explain, how we can classify these risks in different places. No, so let us look at this risk classification in this manner. The risk in different asset class are identified with different kind of name. We have a two different, very, very prominent asset class. One is equity, one is debt. Mixing them two together will be called hybrid. Hybrid we'll discuss little later. So equity will have a two types of risk. One is called unsystematic and one is called systematic. No, systematic and unsystematic. Comes the question, what is systematic risk? And remember, whenever you open your television set and you will see a disclaimer. The disclaimer says investment in mutual fund is subject to market risk. Please read offer document carefully before making investment. So what is that market risk? It is something that you cannot say no to that market risk. That is nothing but systematic risk. Whenever you're investing in a mutual fund, you are dependent on the market performance, system performance. So that basically is that you cannot deny that systematic risk. The other risk is unsystematic. That is a stock specific risk. Now, mutual fund does have ability to reduce this risk. How? The word I remember, you remember in my earlier classes, diversification word was used. If you are diversifying your investment in different asset class, in different securities, in different equity stocks, basically what you are doing, you are minimizing the unsystematic risk. No. So this question comes very often. Unsystematic risk, that is a minimized, that is a reduced, that is a managed by investing in different kind of a portfolio, different diversification that happens over there. Fine. But systematic risk, you cannot say no to that. Now, combining these two in equity, this is called total risk. So you may say total risk is nothing but systematic risk plus unsystematic risk. And systematic risk is measured by a word called beta. Now, beta could be more than 1, could be less than 1, could be equal to 1. So what is beta? Beta is a ratio of performance of a scheme with respect to benchmark. Now, I have a numericals on this in other classes. I will show you how this beta works out to be. But for simple understanding, beta is the ratio that basically is the ratio between the performance of a scheme and the performance of a benchmark. And then you will say immediately, okay, if this is the so, then beta of index fund should be 1. Why? Because beta is 1. So performance of a scheme should be equal to the performance of benchmark. No. But if it is a more than 1, that means aggressive scheme. If it is less than 1, that is called a risk averse schemes. No. So there are aggressive scheme in the mutual fund where beta is more than 1. There are schemes in mutual fund where beta is equal to 1, that is the index fund. And when there are also schemes in mutual fund which is the risk averse, less risky, and their beta is less than 1. I give you an assignment that you look into the fact sheet of different mutual fund and then calibrate and then classify the different schemes based upon beta less than 1, equal to 1, and more than 1. And then you will actually understand what beta stands for, what systematic risk stands for. Together, these two risks are measured by something called total risk, and the measurement of that is called standard deviation. Total risk is measured by standard deviation. Right? That is on the equity side. Now, in the debt side, I told you in the earlier program as well that debt will have a many risks, but two risks are prominently captured in your NISM 5A book. Now, interest rate risk and credit risk, these two are the most prominent. You remember there are 16 types of open-ended scheme in the debt category, and out of that, nearly 7 or 8 schemes have a predominant application of interest rate risk. And other 5, 6 scheme will have predominantly explained using credit risk. So, what interest rate risk and credit risk is there? That basically helps you to understand the different schemes of mutual fund of debt category. See, interest rate risk is nothing but it's a change in the bond value on account of change in interest rate. I will repeat it again. Change in the bond value on account of change in interest rate. How it works? I will give you simple illustration here. Just remember that. Later on in some other classes, I will explain you how it works. So when interest rate comes down in the market, the bond value goes up. When interest rate goes up in the market, bond value comes down. Simple. Inverse relationship between bond value and the interest rate. Fine. That's interest rate risk. What it means? It means when interest rates decline in a financial system, the bond value will appreciate, the NAV of mutual fund portfolio will appreciate, and therefore, longer bond, which is a more sensitive, will have a more appreciation. Shorter bond, which is less sensitive, will have a less appreciation. Simple definition. Listen to this sentence 3, 4 times. And when interest rate in the system goes up, then the NAV depreciate, then the value of investment depreciates. That's interest rate risk. Fine. So in this case, longer bond will have a more depreciation, shorter bond will have a less depreciation. No. So both side inversely it behaves. Interest rate risk functions like this. Very, very important from anybody, for anybody who's investing into bond funds. Then the second comes credit risk. Credit risk basically is a risk attached that explains the credit worthiness of borrower. Now, what is the borrower? Now, debt, is a nothing but obligation. Equity is nothing but an ownership. Debt is nothing but an obligation. So, obligation is what? If I pay you, you pay me back. It's a lending and borrowing contract, lending and borrowing obligation. So, any at any point of time, the borrower is going to borrow from the lenders. Now it's a borrower ability to pay back to the lenders. This credit risk is a measurement of this payment ability, the credit worthiness of that borrower. Higher the ability, lower the risk, and so lower will be the return. That is called sovereign bond, government security, treasury bills. SDL means state developmental loans. So credit risk is nothing but it is assessment of a borrower, its ability to pay back to the lender. Whenever you lend to the government, in that case, we call it a sovereign bond, that is also called zero credit risk. Yes, whenever you come across this word zero risk, that means only zero credit risk. Fine. And then you say there are other corporates, there, of course, a borrower has to earn and then to pay. So in that case, you have a notation given by the different rating agencies. And they give notation, simple popular notations are like triple A, double A plus, double A minus, single A plus, single A, like that. It keeps going like that. And anything below B is called below investment grade. Anything below B is called below investment grade securities, or anything around D is called default grade. No. So depending upon the different notation, you are able to classify the different kind of a bond and its ability of risk and its payment ability, earning ability, and based upon that, different portfolios are created. Fine. So interest rate risk, credit risk are two very, very important criteria. To have a simple measurement here, I will only go by the explanation here in terms of definition. We will not go into the mathematics part over here. Interest rate risk is measured by a word called duration. Now, duration is also known by a word called modified duration, also known by the word called weighted average duration. So that we will not go into details of that. In some other module, we will cover that different types of duration and how they are different from each other. But right now, let us say that interest rate risk is measured by modified duration. That much is good enough. No, and credit risk is measured by something called credit spread. So these two different equity and debt stocks, different securities will have a different element of risk and they are measured differently. For a simple illustration, I can show you one slide on credit risk and that will give you a just idea over here that if the yield to maturity on the y-axis you can see over there, and then the bonds from government security to double A to single you can see over here, and you will find the spread between the G-sec to double A, G-sec to single A, and that spread is going up. This yield spread, this credit spread is nothing but it's a basically measurement of credit risk. So higher the spread, higher the credit risk, higher the yield spread, higher the credit spread, and higher the credit risk. So that is a simple definition for you to understand over here. And in just one slide, you can see whatever I said is written over here. I'm summarizing that simple. Total risk is equal to systematic risk plus non-systematic risk. The non-systematic risk can be neutralized by portfolio diversification. Remember that first sentence we said. And then systematic risk can be measured by beta. It cannot be denied. It has to be taken care in the portfolio. It is also called market risk. Investment in mutual fund is subject to market risk. The total risk is measured by something called a standard deviation. And so in other way, you can say standard deviation is nothing but beta plus diversifiable risk. No, you have a scale of beta is written there. Beta more than one, of course, it's a sensitive, volatile, and more risky. And beta equal to one will be risk neutral. And you know, index funds basically have a beta equal to one. We discussed this earlier. And beta less than one is risk averse. They will have a lesser risky on that. Fine. In some other classes, we'll discuss about risk adjusted return. So that's a different kind of a measurement. We have a Sharpe ratio, we have a Tanner ratio, we have a Sortino ratio. We'll discuss in some other class, not here. This class is only for understanding risk of different types of risk in the mutual fund. We took only three, four, five risks only of mutual fund. There are some other risks, but less important. So for that, you please go through the notes and there you will get all the details. And attempt my MCQ questions and then you will get the complete understanding on these subjects. Thank you. Okay.